A significant and unsettling trend is taking hold within the global financial industry. The once solid bedrock of a career in banking is showing deep and worrying cracks. All around the world, from Wall Street to the City of London and Main Street community banks, a wave of layoffs is gathering momentum. This is not a temporary dip or a cyclical adjustment. Instead, we are witnessing a fundamental, structural transformation that threatens many traditional banking roles. Job security that was once a hallmark of the profession is rapidly becoming a relic. The core issue, the very nature of banking, is being redefined, driven by technology, changing expectations, cost pressures, and a volatile economy. Alone, any of these is significant. Together, they create a perfect storm for job displacement. This trend impacts tellers, loan officers, analysts, back-office support, signaling a deep and permanent shift. The question is no longer if jobs will change, but how drastically and how quickly. For many experienced professionals, the future is uncertain. The quiet in the banking halls is the sound of a world being changed. Next, technology's relentless march. The single most powerful force driving upheaval in banking is the relentless advance of technology. For decades, technology helped bankers do their jobs. Now it increasingly replaces the jobs themselves. Simple innovations like ATMs started the shift. Now the digital revolution sits at the core of financial services. It changes how banks operate, interact with customers, and manage risk. Consider depositing a check. Once a branch visit, now millions use a smartphone camera and an app. Account opening, fund transfers, loan applications, investment management, all handled digitally with minimal human intervention. Inside banks, software automates compliance, reporting, and risk tasks formerly done by teams. The shift reduces the need for large processing workforces and basic customer support roles. Cloud computing and APIs, combined with fintech startups, create a competitive, tech-driven landscape. Fintechs offer convenience and lower costs. Banks must embrace the digital tsunami to survive. That choice leads to a smaller, more technologically skilled workforce, and the disappearance of many established jobs. Next chapter: automation and AI in finance. Beyond digitization, advanced automation and AI are an even more potent catalyst for job displacement in banking. AI is now replacing human cognitive functions. Tasks once requiring meetings, document collection, and human judgment can now be completed by algorithms in a fraction of the time. Systems analyze transaction history, social data, and alternative sources to produce accurate risk scores. The result? Faster processes, more objective decisions, and fewer human underwriters. Robo-advisors create and manage portfolios at a fraction of the cost, and the mass market accepts them. Jobs reliant on pattern recognition, data analysis, and rule-based decisions are at risk. Fraud detection, compliance monitoring, trade settlement, parts of investment research. Banks are investing billions in AI for efficiency, accuracy, and cost savings. New roles will appear to build and manage AI, but they will be fewer than the roles they replace. The workforce implication is stark: fewer people doing higher-skilled technical work. For employees, this means reskilling and competition for technical roles. Next, how customer behavior accelerates branch decline. The physical bank branch, once the cornerstone of community finance, is facing an existential crisis. Branch closing signs appear across neighborhoods. Customers bank from their phones. Younger generations expect banking as easy as ordering food. Why stand in line when autopay takes 2 minutes? Why visit to check a balance when it is at your fingertips 24/7? Foot traffic has declined for over a decade, and the decline is accelerating. Transactions moved to digital channels. Branches became quiet and expensive real estate. Banks are reducing physical footprints to cut rent, utilities, and staff salaries. Closures eliminate roles: tellers, customer service reps, branch managers. Remaining branches are transforming into advisory hubs for mortgage advice, small business lending, and wealth consultations. Tellers and clerks become universal bankers and specialists. Fewer but more skilled staff. The pivot reduces traditional branch jobs across the industry. Some staff are retrained, many are made redundant. Next, why banks keep cutting costs and people. The banking industry operates under immense and sustained pressure to maintain profitability. That pressure comes from competition, regulation, and historically low interest rates. When interest rates are low, net interest margins shrink. A core revenue source gets squeezed. Executives chasing efficiency often use headcount reduction as an immediate lever. Banks are not just trimming fat, they are re-engineering operations to run permanently smaller and more agile. That fuels adoption of automation and technology to do more with less. Fintechs and neobanks are lean competitors offering lower-cost products, amplifying pressure on incumbents. Traditional banks carry legacy IT and branch overhead that new entrants do not. Every department, every process, every role is scrutinized. Automation, centralization, and outsourcing are candidates for elimination. That creates perpetual uncertainty. Job security becomes fragile and tied to quarterly results. Reducing the cost-to-income ratio remains a central strategy, keeping many jobs permanently precarious. Next, wider economic and regulatory forces that amplify risk. Beyond technology and cost-cutting, banks are highly sensitive to the broader economic environment. Global slowdowns, geopolitical instability, and shifting monetary policy create headwinds. When economies slow, loan demand dries up and defaults rise. Bank balance sheets strain. Interest rate moves can both help margins and cool activity. Effects are mixed and unpredictable. Market volatility halts deals. M&A and IPO activity shrink, hitting investment banking revenue and jobs. Traders and analysts are especially vulnerable when markets go quiet. Since 2008, regulation raised capital and compliance costs. Some business lines become less profitable. Banks hired compliance teams, then cut elsewhere to offset those costs. Major shocks, a pandemic, trade wars, regional conflict, ripple through markets and employment. Those shocks feed into hiring freezes and layoffs across banking. Banks must stay nimble and adjust costs quickly, and often that means cutting headcount. Next, how bankers adapt, or are left behind. In summary, banking stands at a critical crossroads, reshaped by powerful converging forces. Technology, automation, and changing customer behavior render many tasks obsolete. The jobs that survive will be those technology cannot easily replicate. Complex problem-solving and strategic client relationships. Creative structuring and ethical oversight of tech will be in demand. The banker of the future will be hybrid, part financial expert, part data scientist, part tech strategist. Digital literacy and analytical acumen will soar in demand. Rote manual skills will continue to plummet. For current bankers, the path is proactive reskilling. Learn AI, blockchain basics, and data analysis, and hone advisory skills. Banks and educational institutions must provide training and clear career pathways. The industry will be smaller in headcount, but will require a technically sophisticated workforce. For those who adapt, rewarding careers remain. For those who cannot, the silence may be permanent. If you found this useful, subscribe for more analysis. Thanks for watching. Resources and suggested reading are in the description.